You ever wondered what it would be like to have your money work for you, even if you have little to start with? Imagine building a solid investment base that grows over time, regardless of the initial value. In today's video, I will show you how it is possible to invest with little money and still achieve great results. This step-by-step guide is perfect for those who are starting from scratch but want to ensure a more secure and prosperous financial future. If you think that investing is only for those who already have a lot of money, get ready to completely change your vision. You can support me in producing more content like this just by subscribing to the channel and leaving a like. If you can, leave a comment from the city where you are watching this video. Let's go. Investing can seem like a scary terrain for those just starting out, and that's absolutely normal. When you are taking your first steps in the world of investments, it is natural to be overcome by a flood of doubts and insecurity. Maybe you're wondering, is it safe to put my money into something I don't fully understand? Or, is it really worth investing if I can barely save money for the month's expenses? And the most common question of all, do I have enough money to start investing? Or am I just dreaming too big? These concerns are legitimate. Many successful investors have been exactly where you are now, wondering if they were ready or had enough resources to begin this journey. What many people don't realize is that the initial value you have is not the determining factor in your success as an investor. What really matters is the discipline with which you approach your investment, consistency with which you contribute to them over time, and, perhaps most importantly, the knowledge you acquire along that journey. Investing is not a sprint, but a marathon. And like any marathon, what counts most is endurance and perseverance, not initial speed. It doesn't matter if you start with 100, 1,000, or 10,000. What makes the difference is the way you deal with the investing process. Patience to wait for results, and the wisdom to learn from mistakes and successes along the way. In this video, I'm not just going to tell you where to put your money. I will guide you step by step, each step of this process. From choosing your first investment, which may seem like a big mystery, to building a diversified portfolio that balances risk and return, all done with little capital, but with a lot of strategy and determination. Let's unveil this universe together and show that investing is for everyone, regardless of their starting point. Step 1. Defining your goals. First step for any investor, and perhaps the most crucial, is to clearly define your financial goals. This may seem simple, but it is a step that many ignore or underestimate, which can compromise the entire investment process in the long term. When you sit down to think about your goals, it's important to not only consider what you want to achieve, but also why those goals are important to you. Ask yourself, why am I investing? This simple question can open doors to a deeper understanding of your motivation, helping you align your financial decisions with the values and dreams that truly matter to you. For example, you may be investing to create an emergency fund, which means your focus will be on security and liquidity, ensuring you have easy access to your money in case of an unexpected need. Or perhaps your goal is to save for retirement, which will require a different approach, more focused on long-term growth and inflation protection. You may also be thinking about achieving financial independence, where your investments will generate enough passive income to cover your expenses, freeing you from the need to work for money. Each of these goals requires a different investment strategy, which is why it's critical to be clear and specific about what you want to achieve. Furthermore, having clear goals will help you maintain focus and discipline over time. Investing is a journey, and like every journey, there will be challenges and obstacles along the way. There will be times when the market is not in your favor, when your investments may underperform, or when you may be tempted to give up and withdraw your money. It's in these moments that your clear, well-defined goals will serve as a beacon, guiding your decisions and keeping you on the right path. And don't worry if your goals seem too big for the little money you have now. Key is to start, no matter how much you have. With time, discipline, and consistency, your small investments can turn into big financial achievement. Therefore, before making any move in the financial market, take the time to reflect deeply on what you really want to achieve with your investment. Write down your goals, be specific and realistic, and keep those goals in mind in every decision you make. Remember, investing is not just about making money. It's about using money as a tool to achieve the dreams and freedom you want in life. When your goals are clear, everything else becomes easier, and you'll be on a safer path to financial success. Step 2. Financial education. Before investing any amount, no matter how small, it is essential to dedicate time and effort to educate yourself financially. This is a step that many beginners skip in their eagerness to see their money grow quickly. A lack of knowledge can lead to costly mistakes that could be avoided with a solid foundation of understanding. Educating yourself financially is not just a matter of learning technical terms or understanding complicated charts. It's about acquiring a mindset that will allow you to make informed and confident decisions, ensuring that every penny you invest works for you, not against you. First, you need to understand the basics about the different types of investments available. There are stocks, which represent a small part of a company and have the potential to offer high returns, but also come with a considerable level of risk. There are bonds, which are basically loans you make to governments or companies in exchange for an interest payment, generally considered a safer option, but with lower returns. Additionally, there are investment funds, which allow you to diversify your investments without having to choose each asset individually, making them an excellent option for beginners. And we cannot forget real estate, which, although it may require greater initial capital, is a tangible and often stable form of investment in the long term. Understanding the risks and rewards of each type of investment is crucial to making decisions that align with your goals and risk tolerance. If you have a more conservative profile, you may prefer to invest most of your money in safer options, such as bonds and low-risk funds. If you are more aggressive and are willing to face market volatility, seek greater returns, and choose to invest in stocks or startups. The important thing is that these decisions are informed and based on solid knowledge, not impulses or unfounded tips. These days, there are an abundance of resources available for anyone who wants to learn about investing, many of which are free. You can start with specialized blogs where professionals share their experiences and market analysis. Podcasts are also a great way to learn while you do other activities, like driving or exercise. And of course, YouTube videos like this one that offer step-by-step tutorials and in-depth reviews. The key is to be proactive in your education. Don't wait for the information to reach you. Seek, ask, question, and above all, be willing to continually learn. The financial market is constantly evolving, and the investor who stays informed is the one who is best prepared to navigate uncertainties and take advantage of opportunities that arise. Investing time in your education now can save you from many mistakes in the future. Mistakes that, in some cases, can be very costly. Financial education is the foundation on which you will build your investment strategy. And the stronger this foundation, the more solid your path towards financial independence will be. Therefore, before making your first investment, or even if you have already started investing, never stop learning. Knowledge is your greatest ally, and the more you know, the more power you will have to transform your finances and, consequently, your life. Step 3. Starting with low-cost investments. When you are starting out in the world of investing with little capital, it is essential to be strategic in choosing where to put your money. The temptation to seek big gains quickly can be strong, but it is important to remember that the initial focus should be on building a solid foundation that allows for sustainable growth. This means opting for investments that do not require large initial investments, that offer the opportunity to learn, grow, and diversify as you gain more experience and confidence in the market. One of the most accessible options for those just starting out are index funds, or ETFs, exchange-traded funds. These funds are a great way to get started because they offer instant diversification, allowing you to invest in a basket of stocks or bonds with a single purchase. This reduces the risk associated with investing in a single stock or bond and makes it easier for beginners to understand the market as a whole. Plus, ETFs generally have much lower management fees than other types of funds, meaning more of your money stays invested, working for you. In the long term, these small details can make a big difference in your profitability. Another advantage of ETFs is that they are extremely flexible. You can buy and sell them easily, just like you would individual stocks, but without the need for great technical knowledge or in-depth analysis of each company. This makes them an ideal choice for beginner investors who want to enter the market without worrying about constantly monitoring each investment. Additionally, there are ETFs that follow indices from different sectors of the economy, allowing you to invest in specific areas, such as technology, health, energy, or even international markets, all in an accessible way and with low initial costs. Online investment platforms are also a powerful tool for those starting out with little capital. These platforms have revolutionized access to the financial market, allowing anyone, any amount, to start investing. Many of these platforms offer fee-free accounts for small investors, which eliminates a significant barrier for those with little cash on hand. Additionally, they often offer a range of educational resources, from video tutorials to investment simulators, that help you learn while you invest. Another effective strategy for starting with little capital is investing in fractional shares. Some brokerages allow you to buy fractional shares, which means you don't have to wait until you have enough money to buy an entire share of a large, well-established company. This makes it possible to diversify your portfolio from the start, even if you're investing very small amounts. Over time, as you continue to invest regularly and reinvest your dividends, these small holdings can grow significantly. Finally, it's important to remember that regardless of the investment you choose, the most important thing is to get started. The act of starting to invest, even if it's a small amount, already puts you ahead of most people who never move from planning to action. The power of compound interest and time on your side are factors that cannot be underestimated. The sooner you start, the greater the rewards you will reap in the future. So, don't expect to have a large amount to start. Invest what you have now, learn from each step, and continue to grow, both in knowledge and capital. The most important thing is to take the first step and start building your financial journey. Step 4. Automate your investments. One of the most powerful and underrated strategies for those starting to invest with little money is investment automation. Automation not only simplifies the process, it also helps maintain the discipline necessary for long-term financial success. When you automate your investments, you are creating a system that works for you, ensuring that your financial goals are achieved, regardless of distractions or unforeseen circumstances that may arise along the way. Automating your investments means setting up automatic monthly transfers from your checking account to your investment account. It sounds simple, but this small step can make a huge difference in the long run. Why? Because it eliminates the need to make repetitive decisions about how much and when to invest, turning this action into an automatic habit. By establishing a fixed amount that will be invested every month, you guarantee that you will be continually building your wealth, without having to rely on your willpower or memory to remember to make the contributions. This is especially useful in months when expenses may be higher, or when you may be tempted to spend that money on other things. Additionally, automation allows you to harness the power of average investment cost. When you invest a fixed amount at regular intervals, such as monthly, regardless of market conditions, end up buying more stocks or fund shares when prices are low and less when prices are high. This process, known as dollar cost averaging, helps smooth out market fluctuations and can result in a lower average purchase price over time. This is particularly advantageous for beginning investors who are still learning to deal with market volatility and want to avoid the mistake of trying to time the market, which is notoriously difficult for even the most experienced investors. Automating your investments also helps you avoid analysis paralysis. Many people get stuck trying to decide the best time to invest or whether to wait for a market drop, ending up doing nothing. By automating, you remove this mental barrier, as the investment happens automatically, without you having to make the decision every month. This also helps reduce the stress and anxiety associated with investing, as you know you are making steady progress towards your financial goals, even if the market has short-term swings. Another great advantage of automation is that it promotes consistency, which is one of the pillars of success in investment. Investing regularly, month after month, creates a habit that, over time, can generate surprising results, thanks to the effect of compound interest. Even if the initial amounts are small, by investing consistently over the years, these amounts can grow exponentially, creating a solid and lasting financial foundation. Finally, by automating your investments, you free up time and mental energy to focus on other important areas of your financial and personal life. With the peace of mind of knowing that your investments are progressing, you can focus on increasing your income, exploring new investment opportunities, or simply enjoying life without constantly worrying about your finances. Automation is therefore a way to make the investment process as efficient and stress-free as possible, helping you achieve your financial goals faster and more smoothly. If you haven't automated your investments yet, start considering this strategy right now. Even if you're just starting out, automation can be what helps you maintain the consistency and discipline that are essential for long-term success. The journey to building solid wealth and ensuring your financial security begins with small, automated steps, which together, over time, create a powerful chain of progress towards your goals. Step 5. Increase your contributions over time. Starting to invest with little money is an excellent first step, but to really accelerate the growth of your assets and achieve your most ambitious financial goals, it is essential to increase your contributions over time. As your financial situation improves, whether through a salary increase, extra income, or reduced expenses, it is important to direct part of these new resources to your investment. This practice not only boosts the growth of your portfolio, but also reinforces the habit of prioritizing your financial future. Let's explore why increasing your contributions over time is so crucial. Initially, when you start investing with a modest amount, compound interest works for you. The gains may seem small and slow. However, as you continue to invest consistently and increase the value of your contributions, these gains begin to grow exponentially. This is because compound interest works better the larger your initial capital, generating increasingly greater returns as your portfolio grows. Each new contribution adds more capital to the equation, which in turn generates even more compound returns. It's a virtuous cycle that becomes increasingly powerful over time. To illustrate this, imagine that you started by investing $100 per month. At first, growth may seem slow, but suppose, after a few years, you manage to increase this contribution to $200, then $300, and so on. Each increase in the investment value significantly accelerates the growth of your portfolio. Even though the market goes through ups and downs, the simple act of investing more money regularly puts you in a much stronger position to achieve your goals. Over time, these additional contributions can make a huge difference, transforming a modest portfolio into a substantial source of wealth. In addition to simply increasing the value of your contributions, another powerful strategy is to channel any additional income you receive directly into your investment. This could include year-end bonuses, tax refunds, even profits from sales of items you no longer use. Instead of spending that money on immediate consumption, directing it towards your investments can dramatically accelerate the growth of your portfolio. Each time you do this, you are effectively giving the power of compound interest a big boost, making it work even harder in your favor. Another way to increase your contributions over time is to adopt an expense reduction mindset. By regularly reviewing your budget, you can identify areas where you can cut spending without sacrificing your quality of life. It might be something simple like reducing entertainment spending or renegotiating service contract, but these cuts can free up money that can be redirected to your investments. This approach not only increases your contributions, but also teaches you to value each dollar invested more, reinforcing a long-term and wealth-building mentality. Furthermore, increasing your contributions over time also requires discipline and commitment. It's easy to get sidetracked when other spending opportunities appear, or when consumer temptations arise. However, staying focused on your long-term goals is essential. A good practice is to regularly review your financial goals and portfolio progress. This helps you maintain motivation and discipline to continue increasing your contributions, even when the market is volatile or when your personal finances go through moments of uncertainty. In short, increasing your contributions over time is a fundamental strategy for accelerating the growth of your assets and achieving your financial goals more quickly and efficiently. Starting small is the first step, but the true power of investments lies in consistency and the ability to increase your contributions as your financial situation improves. Remember that each additional dollar invested is not just more money put into the market, but an opportunity to accelerate your gains and build a more solid and secure financial future. The key is to stay focused, keep learning, and never stop investing in yourself and your future. Step 6. Diversify. Protect your investment. As you begin to gain more confidence and accumulate more capital, it is absolutely essential to understand the importance of diversification in your investment strategy. Diversifying your investments is like building a safety net for your portfolio. It's one of the most fundamental rules of investing and is often considered one of the best ways to protect your assets against market volatility. The idea behind diversification is simple. Don't put all your eggs in one basket. This means that if one specific investment isn't doing well, the others can make up for the losses, keeping your portfolio in a healthy balance. Let's explore this in more depth. When we talk about diversification, we are referring to the practice of spreading your investments across different types of assets, sectors, and even geography. For example, instead of investing all your money in technology stocks, which can be very volatile, you can spread your investments among technology stocks, consumer company stocks, fixed income securities, real estate funds, and even commodities like gold or silver. Each of these investment categories reacts differently to economic conditions. When one category is down, another may be up, and this variation helps to balance your portfolio, minimizing risks and enhancing returns. Diversification is not just limited to different asset classes. Within each class, like stocks for example, you can also diversify by investing in different sectors of the economy, such as health, energy, finance, technology, and so on. This is important because, at any given time, different sectors can be affected by different economic and political factors. For example, crisis in the energy sector can severely impact the shares of oil and gas companies, but at the same time, can benefit shares of renewable energy or green technology companies. By diversifying across sectors, you protect yourself against the concentration of risk in a single area of the economy. Furthermore, geographic diversification is another crucial aspect to consider. Investing in international markets can protect your portfolio against risks specific to a single country, such as recessions, political crises, or currency fluctuations. Emerging markets, for example, offer growth opportunities that can be much greater than those found in developed markets, although they also come with greater risk. By combining investments across different regions, you can balance these risks and opportunities, ensuring your portfolio is prepared to face a variety of global economic scenarios. A common mistake that many investors make is thinking that they are diversified just because they have a variety of stocks in their portfolio. However, if all of these stocks belong to the same sector or the same asset class, your portfolio is still highly exposed to the risk specific to that sector or class. True diversification goes beyond this, encompassing multiple assets, sectors, and regions, creating a robust portfolio that is resistant to inevitable market fluctuations. Remember that diversification must also be adjusted over time. As your portfolio grows and the market evolves, it's important to regularly review your positions and make adjustments as needed. If a certain sector or asset starts to represent too large a portion of your portfolio due to its growth, it may be wise to rebalance by selling part of that asset and redistributing the profits to other areas that are underrepresented. This rebalancing practice not only keeps your portfolio diversified, but also helps ensure you remain aligned with your financial goals and your risk tolerance. In short, diversification is an essential strategy for any investor, regardless of the size of your portfolio. By spreading out your investments, you not only reduce the risk of significant losses, but you also open the doors to new growth opportunities. Whether diversifying across different asset classes, sectors, or regions, the goal is to build a portfolio that can withstand market ups and downs, ensuring you're always on track to achieve your financial goals. Diversification is your shield against uncertainty, and when used correctly, can be the key to lasting financial success. Step 7. Stay informed and reevaluate regularly. Investing is a dynamic and continuous process, which requires not only discipline, but also constant adaptation to changes in the market and your own financial life. Therefore, the last essential step to long-term investment success is to stay informed and regularly reevaluate your investment portfolio. Many investors make the mistake taking a set-it-and-forget-it approach to their investment, which can be dangerous, especially in an ever-changing economic environment. Protect and enhance your investments. It is crucial to always be aware of market trends, reviewing your strategies and making adjustments as necessary. Staying informed means keeping a close eye on what's happening in financial markets, global economies, and the companies you've invested in. This may seem intimidating at first, but there are countless tools and resources available to make this process easier. Financial news, analyst reports, investment newsletters, and even informative videos are great ways to stay up to date. Knowledge is your greatest ally when it comes to investment. The more informed you are, the more prepared you will be to make decisions that maximize your returns and minimize risks. Additionally, staying up to date allows you to identify new investment opportunities before others, giving you a competitive advantage. In addition to monitoring the market, it is essential to regularly reevaluate your investment portfolio. This doesn't mean you should make frequent or drastic changes, but rather that you should review your portfolio to ensure it is still aligned with your financial goals, your risk tolerance, and current market conditions. For example, if you started investing in shares of a certain company because you believed in its growth potential, but over time, the company's prospects changed, it may be time to reconsider that position. Likewise, if a specific sector has started to show signs of weakness, you may want to rebalance your portfolio to reduce your exposure to that sector. Reevaluating your portfolio also involves analyzing whether your asset allocation still makes sense for your current situation. As you age or as your financial goals change, you may need to adjust your investment strategy. For example, a young investor may have the luxury of taking on more risk by investing in growth stocks with high return potential. But as they approach retirement, they may want to move into more conservative investments, such as fixed income securities. Protect the assets you have accumulated. This reevaluation process should be done regularly, at least once a year, or in response to significant events, such as changes in your personal life or major market movement. Another important aspect of revaluation is rebalancing your portfolio. Over time, different assets will perform differently, and this can change the original allocation you set. For example, your stocks have performed very well and grown in value. They may represent a larger part of your portfolio than you initially planned. Rebalancing involves selling some of the assets that have performed well and buying more of those that have lagged, restoring balance to your portfolio. This practice helps keep your risk exposure within levels you are comfortable with and ensures you are always aligned with your long-term goals. Finally, it is important to remember that the world of investments is dynamic and constantly evolving. New opportunities arise, sectors emerge, and the global economy changes rapidly. To maximize your returns and minimize risk, you need to be flexible and willing to adjust your strategy as needed. This does not mean following fads or making impulsive changes, but rather being prepared to adapt to new realities when necessary. Staying informed and regularly reevaluating your portfolio is what will allow you to navigate market uncertainty and continue to grow your wealth over time. In conclusion, investing success depends not only on making the right choices at the beginning, but on continually monitoring and adjusting your approach to ensure you are always on the right track. By staying informed and reevaluating your portfolio regularly, you will be well equipped to face market challenges and take advantage of opportunities that arise. Remember that investing is a long-term journey, and the key to success is patience, continuous learning, and the ability to adapt. With these principles in mind, you'll be on your way to achieving your financial goals and building a solid, prosperous financial future. Investing with little money is undoubtedly a challenge, but it is also a powerful opportunity to transform your financial life, even if you are starting from scratch. Throughout this video, we explore how each step can lead you to building a solid foundation for growing your wealth, regardless of the initial amount you have available. We start by defining the importance of establishing clear objectives, which will serve as a guide for all your financial decisions. Next, we talk about the need to educate yourself financially, a crucial step to making informed decisions and avoiding common pitfalls. We also discuss the importance of starting with low-cost investments and how automating your contributions can ensure that you are always moving forward, even if day-to-day life is busy or spending temptations arise. We emphasize the need to increase your contributions as your financial situation improves, making the most of compound interest to accelerate the growth of your portfolio. We cover diversification as an essential strategy for protecting your investments against market volatility and risk. And finally, we discuss the importance of staying informed and regularly reevaluating your portfolio to ensure you are always on the right track. By consistently applying these strategies, you will not only be building an investment portfolio, but also developing a mindset that values planning, discipline, and continuous learning. These are the qualities that differentiate successful investors from those who fall by the wayside. Money, when well managed, has the power to provide freedom, security, and the realization of your dreams. And this journey begins with the first decisions you make today. Now, think about how this could impact your life in the long term. Imagine what it would be like to have the peace of mind of knowing that your financial future is assured, that you are in control of your trajectory, and that, regardless of the ups and downs that may occur, you have a solid, well-structured plan. The path to financial success is not linear, and it is certainly not easy, but it is accessible to everyone who is willing to take the first steps, continually learn and adapt to changes along the way. Therefore, I encourage you to start today. Apply what you learn here and continue to evolve as an investor. Don't underestimate the power of small actions taken consistently over time. Every decision, every contribution, every adjustment you make to your portfolio is a step towards your ultimate goal. Remember, the most important thing is not where you start, but the direction in which you are going. Success in investing is a marathon, not a sprint. And those who persist, who learn, and who adapt are those who reap the greatest rewards. If you enjoyed this video, consider subscribing to the channel and hitting the like button so you don't miss out on other content that will help you thrive financially. Your support is crucial for encouraging me to keep producing more. Thank you very much.